AMD offered OpenAI the right to buy up to 160 million shares at 1 cent each. And then, AMD offered a warrant for Meta for a separate 160 million shares at 1 cent each. These shares do not vest automatically though. Meta and OpenAI must purchase enormous amounts of AMD compute, meet deployment milestones, and satisfy share price conditions. Buy the product, help grow the supplier, potentially become one of its biggest owners. And that is only one link in a massive web. NVIDIA invested $30 billion in OpenAI. Amazon committed $50. Microsoft says that OpenAI contracted a further $250 billion worth of Azure services. OpenAI received AMD warrants, received CoreWeave shares, committed more than $20 billion to Cerebras, and then lent Cerebras roughly another billion to build the capacity that it had ordered. NVIDIA also agreed to buy billions of CoreWeave capacity if other customers do not use it. This is not one circular deal. It is a network in which the customer, supplier, investor, lender, and shareholder are increasingly the same companies. And so the question is not whether the revenue is fake. The question is who supplied the money, who received the incentive, and of course, who carries the risk if demand disappoints. OpenAI agreed to deploy up to 6 gigawatts of AMD GPUs. AMD issued OpenAI a warrant for up to 160 million shares at 1 cent each. The first tranche vests with the initial gigawatt, and additional tranches vest as purchases scale towards 6 gigawatts. Then AMD repeated the structure with Meta, up to 6 gigawatts of deployment and a separate warrant for another 160 million shares, again tied to shipments and AMD share price targets. This does not make the demand imaginary, but it is not an ordinary customer discount either. The customers buying the hardware can gain enormous ownership in the supplier, whose revenue their purchases are helping create. That is a powerful incentive. An investor should separate the product demand from the equity package attached to it. NVIDIA invested $30 billion in OpenAI, while OpenAI secured next-gen NVIDIA compute. Amazon committed $50 billion to OpenAI. At the same time, OpenAI and AWS expanded their existing agreement by another $100 billion over 8 years, including roughly 2 gigawatts of Trainium capacity. CoreWeave added another variation. Alongside a major compute agreement, CoreWeave gave OpenAI just under 9 million shares through a private placement connected to CoreWeave's IPO. Follow the money. Capital enters OpenAI from infrastructure providers. OpenAI then signs enormous compute commitments with infrastructure providers. Some of that capital can return to investors as cloud or hardware revenue. That does not invalidate the contracts, but it does mean that the investor is helping finance the customer that may just end up generating its future revenue. OpenAI represents a very large amount of Microsoft's future contracted business. But Microsoft says that nearly 90% of the revenue it earns today comes from business outside of the frontier AI companies. So, Microsoft's future backlog is heavily concentrated in OpenAI, while its current cloud revenue comes from a much broader customer base. Microsoft therefore weakens the claim that the entire AI boom is one closed loop, but it does strengthen the argument that investors must separate the current revenue from future contracted demand. Cerebras is the most extreme version of the network. OpenAI committed to purchase 750 megawatts of Cerebras inference capacity and related services in an arrangement worth more than $20 billion. But Cerebras still had to finance and build much of that capacity, so OpenAI provided a loan of roughly $1 billion at 6% interest. The loan can be repaid in cash, but also through service fees and compute capacity. OpenAI also received warrants. Even Cerebras treats the loan and the compute contract as one linked deal. OpenAI is not only the customer, it is also financing Cerebras while Cerebras builds the capacity OpenAI ordered. And there is one more warning for anyone looking only at the headline profit. Cerebras reported positive GAAP net income for 2025, but the underlying business still had an operating loss. A large one-time non-cash accounting gain flipped the bottom line. The technology can be real, the contracts can be real, and yet the economics are still far less mature than the headlines suggest. CoreWeave shows another version of the same risk. NVIDIA supplies the chips and owns CoreWeave shares. Under a separate order initially valued at $6 billion, NVIDIA is also obligated to purchase CoreWeave capacity that any other customers don't want to use. The supplier is helping protect the utilization of infrastructure built around its own hardware. Again, the demand may be real, but part of the utilization risk has moved back from the independent customers to the supplier. And now Wall Street has entered the picture. Larry Fink said that the computing power should become its own asset class, similar to how they pioneered the mortgage-backed securities. You know, the mortgage-backed securities that did so well in 2008. Obviously, computing is not mortgages, but look at the progression. We went from selling chips to financing buyers, to backing their own capacity, and now we are turning compute itself into a financial asset class. And that is one hell of a progression. None of this proves that AI is fake. It does not mean fraud. It does not mean that we should ignore the revenue. The risk is concentrated, financed, and self-reinforcing revenue. So stop asking whether AI revenue is growing. Ask better questions. Who supplied the money that allowed the customer to place the order? Did the customer receive warrants, shares, or any other incentive in order to purchase? Who carries the risk if the infrastructure is not fully utilized? And is final demand producing enough cash from independent users to support every loan, every lease, and commitment above it? The AI revolution may be real, the product may be valuable, the accounting may be legitimate, but when the customer, supplier, lender, and shareholder increasingly become the same companies, revenue growth no longer tells us who is ultimately paying. And right now, that may be the most important question in the AI boom.